Hello class, and a very warm welcome to today's explainer. We're going to dive straight into the core principles of IND AS 12 and hopefully completely demystify deferred taxes for your upcoming exams. Now, I know this topic feels quite intimidating when you first look at it, but don't you worry. By the end of our session, you're going to see the incredibly clear, logical framework behind the whole thing. Right, let's get started.
Let's quickly run through our agenda. First up, objective and scope. Number 2, mastering the tax base. 3, recognizing temporary differences. 4, measurement rules. And finally, number 5, presentation and disclosures.
Moving to Section 1, Objective and Scope. Let's understand the why. So kindly note that the entire core issue here arises because the accounting profit we calculate for our shareholders, well, it very often differs from the taxable profit calculated by the taxation authorities. You see, as accountants, we strictly use accrual concepts, right? We want to match revenues and expenses. But the income tax department, they use their own rules. They might tax cash received in advance, or maybe disallow certain provisions until you actually pay them out. And that timing difference right there, students, that is the exact birthplace of deferred taxes.
Now, I want you to literally star mark this specific quote from paragraph 10 in your textbooks. It is the absolute fundamental principle, and really, it's going to be your ultimate doubt clearance tool today. Basically, if recovering the carrying amount of an asset is going to make you pay more tax in the future than if it had no tax consequence at all, well, then you have a deferred tax liability today. It's as simple as that.
Please pay close attention to the scope here. While IND AS 12 covers all domestic and foreign taxes that are based on taxable profits, it explicitly does not deal with government grants or investment tax credits. The accounting for government grants is handled totally separately under IND AS 20. Although, mind you, any temporary differences that arise from those grants, those absolutely do fall back under our purview right here.
Okay, Section 2, Mastering the Tax Base. This is a very crucial definition. Simply put, what is the tax base? It's the exact value that the taxation authorities assign to your asset or liability. And like we just discussed, this very often differs from your carrying amount in the balance sheet. The easiest way to remember this is to just think of the tax base as the income tax department's personal version of your balance sheet. So how exactly do we calculate it? Well, for an asset, it's simply the amount the tax department will allow you to deduct in the future against taxable economic benefits. Just imagine a big, heavy factory machine humming away on your production floor. If that machine costs rupees 100 and rupees 30 of depreciation is already deducted for tax purposes, then the tax base of the machine is rupees 70. The taxman is essentially saying, yes, I will allow you to deduct this remaining rupees 70 against any future taxable revenues generated by this specific machine. Conversely, let's look at liabilities. Here, the tax base is your carrying amount less any amount that will be deductible for tax in future periods. Let's say you have accrued leave and encashment expenses of rupees 100 for your hardworking employees. But the tax rules state it will only be deductible on a cash basis when it's actually paid later. What happens? Well, the tax base of that liability is exactly nil. Your carrying amount is 100, your future deduction is 100, leaving a tax base of 0.
Let us move on to Section 3, recognizing temporary differences. This is where we recognize those gaps.
Now, I hope this is completely clear. Whenever you face a deferred tax problem in your exam, you absolutely must rigidly follow these 4 straightforward steps. Please do not skip any. First, find your carrying amount. Second, determine the tax base. Third, calculate that temporary difference. And fourth, apply the correct tax rate. Following this structured approach is going to save you from so many silly mistakes.
But how do you know if that difference is an asset or a liability? I want to give you a memory technique for this side-by-side comparison. Just remember the golden rule, carry more, pay more. If the carrying amount of an asset is greater than its tax base, it is a taxable temporary difference, which creates a deferred tax liability. Think about it. You are carrying more value in your books than the taxman currently allows, so you are definitely going to pay more tax in the future when you finally recover that value.
Of course, as with any accounting standard, there are exceptions to recognition. And for your exams, you can easily memorize them using the GIB rule, G-I-B, Goodwill, Initial Recognition, and Business Combinations. For instance, if you were to recognize a deferred tax liability on the initial recognition of goodwill, it would just mechanically increase the goodwill figure itself, creating this bizarre endless loop. So the standard very practically forbids this.
Now, moving to deferred tax assets, we see a brilliant illustration of prudence in accounting. While liabilities are almost always recognized, prudence dictates that a deferred tax asset for a deductible temporary difference is only ever recognized if it is probable that future taxable profit will be available. Because honestly, it's completely pointless to have a massive tax deduction sitting there if you don't actually expect to make any profits to deduct it from.
Building right on top of that prudence concept, unused tax losses and unused tax credits are treated very similarly. Kindly note, here students, that a history of recent losses is very strong evidence that future profit might just not be available. So, if your company is consistently making losses, you're going to need convincing other evidence, maybe some highly robust future contracts or some clever strategic tax planning opportunities to actually justify recognizing an asset for those unused tax losses.
All right, Section 4, Measurement Rules. Time to apply the maths.
So the really crucial point here is figuring out which tax rate to use. You must strictly measure these using the tax rates expected to apply in the specific future period when the asset is realized or the liability is settled. But listen, we don't use a crystal ball. You have to base it only on tax laws that are enacted or substantively enacted by the end of your reporting period. For example, if the finance minister has tabled a budget that is essentially certain to pass Parliament, we consider that substantially enacted.
Now, let me pose a very common exam question to the class. Examiners absolutely love testing this one. Since deferred tax deals with tax payments that might happen years and years from now, should we apply the time value of money? Meaning, should we discount these deferred tax assets and liabilities to their present value?
The answer is a massive no. The standard unequivocally states in paragraph 53 that deferred tax assets and liabilities shall not be discounted. Why? Well, just imagine scheduling the exact timing of every single temporary difference reversal for a huge corporate entity. It would be wildly complex, highly subjective, and completely impractical. It would just create huge inconsistencies between different companies, so the rule is a flat, hard no. Let's revise this concept with an example straight from the standard, showing a property that's been revalued to rupees 150. I want you to notice how the deferred tax measurement fundamentally changes depending entirely on management's intent. If we expect to recover the value by actually using the building over time, we pay regular tax on the full revalued amount. But if we expect to just flip it for an immediate sale, well, the capital gains rules might apply differently, perhaps even with a nil tax rate on the proceeds in excess of cost, as you can see right here. So your measurement must precisely reflect your planned manner of recovery.
Almost done. Section 5, Presentation and Disclosures, how we show the final figures. A common question I get is, sir, can we just net off our deferred tax assets and liabilities to show one single clean figure on the balance sheet? Absolutely not. You cannot simply mix them. The criteria are strict. You may only offset a deferred tax asset against a liability if you have a legally enforceable right to set off current tax assets against current tax liabilities and, vitally, both relate to income taxes levied by the exact same taxation authority. I mean, you obviously cannot offset a tax asset from the Indian government against a tax liability owed to the UK government, right?
Always remember what we call the mirror principle. The accounting for the tax effects must perfectly follow the underlying transaction. If a transaction goes to profit or loss, the tax goes to profit or loss. If an asset revaluation gain went straight into other comprehensive income, or OCI, then the corresponding deferred tax liability must also go directly to OCI and definitely not to your profit and loss account.
I truly hope this explainer has stripped away the mystery surrounding IAS 12 for you. If you are ever stuck on an exam question, always fall back and ask yourself this one fundamental question. Will recovery make my future tax payments larger or smaller? It works every time. But let me leave you with this final, somewhat provocative thought. As global tax laws rapidly evolve in our modern digital economy, how will these very static accounting principles adapt to value creation that we can't even physically see yet? Keep that intriguing thought in your mind as you master these foundations. Good luck studying, and I will see you in the next session.